Hey guys, how's it going? We're going to do our normal weekly market review. It will also serve as the aftermarket video that I didn't do on Friday. But other than that, our normal review of the markets, are there any questions? Anything that you want me to for sure go over? And it doesn't have to just be market. It can be energy stuff or whatever as well. Well, it might be interesting for YouTube, but it's okay. We're more than happy to answer any questions whatsoever. No? Okay. So if you end up having one or think of something, just let me know, and I'll be sure to get to it. So let's go over to. I'll keep my chat open in case you guys ask something. Okay. All right. So let's start with. So last Friday morning, we started to take a look at the dollar, which we hadn't looked at in a little while. So the dollar is going to be very important because if the dollar keeps on slipping, then that means assets priced in dollars, they can keep on going up. We got a doji candle on Friday, so we didn't really move anywhere. I guess we did relative to the previous day close, it did move a little bit lower, but that's a doji candle. There's no volume on indices. So let's find an ETF, dollar ETF. I'm blanking on it. US dollar ETF. UUP. Okay. UUP, not much volume, way under the average volume. And this one, we didn't get a doji candle. This one rose right into, well, actually, I'm not going to talk about moving averages with currencies. So DXY. Okay, so not on huge volume. We had this doji candle. So this could continue moving downwards. And we have a bunch of economic data coming up in the next week. We had the actual inflation report. We have retail sales and PPI, and then Michigan consumer sentiment. I'm not as concerned about. So depending on how those go, those could influence the US dollar, but there's so many other things other than the US economics that influences the US dollar. It's how much commerce is being done internationally, how much people are transacting in commodities that are priced within the US dollar, and then how much other countries are buying US debt. So that's going to be more and more important as the US debt increases more and more, and our ability to service that debt decreases. There will be at some point a shift in demand where countries and banks will desire US bonds less and less, and that will require the US to pay higher interest rates, or in other words, we'll have to give them more US dollars in order for them to take that debt, and that'll devaluate the US dollar as well. So if this keeps on going, we could definitely see a rise or a continued rise in asset prices. If I look at the bonds are, they've been, okay, a couple ways to look at this. We have this flat bottom at this purple line right here. And we've got, let's borrow this one. We've got this. Okay, that's the most immediate apparent one to me. You could also draw it like this, but there's not as many lines supporting that. Yeah, I guess that works okay as well. So this downward sloping channel, or you can view it as a a triangle right here. In any case, it doesn't look like the bond prices can continue to move upwards because that would imply an imminent cut in rates, which it doesn't seem like we're going to get. At the very earliest, it seems like we might get it in the summer, but probably more likely in the fall or the end of 2024. If we hear the Fed start pushing that timeline further back, then this is going to crash, and the indices, the SPY, the QQQ, they'll have the potential to crash as well, which might be okay. Crash meaning a 5% to 10% pullback or correction, maybe even 15%. In order for us to go into bear market mode, we would need to see a decrease of at least 20%. That doesn't seem too likely in 2024. Who knows about 2025? We would have to evaluate that closer to the end of the year, after the elections, actually, because the elections are such a big event that they will cloud your ability to predict or see beyond the elections. So for now, the S&P is bullish and it is continuing this upward trend. And there is good potential for it to remain bullish throughout 2024, but not necessarily on this exact trajectory. That would be pretty crazy if it just kept on going through the end of 2024. And I would say that the chances of that are very low, and if not impossible, because this is, I can't even fit it on right, I can't even fit it without really messing with the scale here. So we shouldn't realistically expect that we're going to hit over, close to 700 by the end of the year. That's a little ridiculous. We'll be lucky if we hit, 600 by the end of the year. What that means is that there has to be a pullback. There has to be a slowdown in this rate of growth. So there has to be a sideways movement or a downward movement before we resume upwards. There's no way, I call it well below 1% chance, that this can continue to resume at this rate, and so that we end up around 700 by the end of the year. So we're just waiting to see when that happens. When is that slowdown going to happen, or when is that pullback or correction going to happen? Overall, we do expect the S&P 500 to remain in a bullish pattern or a uptrend for the rest of the year. Maybe slightly interrupted. Like, do you call that a pullback, or do you call that a correction, or do you call that a bear market from June to November? Well, it's not a bear market. We can pretty comfortably say that. Okay, it pulled back 11%. That would be a correction. So that's the same thing as me saying, okay, well, back here, this couldn't keep on going from March 2023 all the way to March 2024. Again, I have to adjust this time scale in order for me to do that. March 2024. That would have been the same thing as us saying, hey, this can keep going all the way for the entire year. Well, obviously not. Obviously, in 2023, there was this pullback or this correction before we resumed this upward trend. So we are still anticipating and watching out very carefully for when that pullback might occur or that correction might occur. We are at a place where there's a heightened probability of it, because from this bottom to the top, we've gone up over 25% now. And I can remove these red lines. We don't need those anymore. And then what I want to see is 30%, because basically the upper edge of what we've seen before is about 30%. So that puts us at about 530. So let's put a line at 530. 30% gain from low. Oh, let me change that color. That looks weird. Okay. Okay, so 30 is about the maximum we can expect before markets run out of money now, or market makers run out of money. Now, if there is cash injection into the market, or like we started out looking at the dollar coming down, then it is conceivably possible that we could get beyond the 30%. But even with that, it would have to be a massive amount of injection or a very steep drop in the US dollar in order to get us significantly above 30%. So I think 30% is a good estimation, is a good place for us to at least initially pay attention to. Right now, again, there's no guarantees that we'll get there. We could fall from any point between now and that 30%. We've already gone up 25%. It is an appropriate level for us to move upwards, or sorry, move downwards. So we just want to be very, very careful and very judicious in our selection of assets that we go into, especially to the upside. At any moment in time, though, they could reverse, but that's part of investing, right? Or trading, or whatever you want to call it. You're never going to capture 100%. So I might make 7, 8, 9, 10 really great trades, and then on the reversal, I'll lose some money because I don't know exactly when it's going to turn around, and that's okay. If I made 7, 8, or 9 or 10 really great trades and then I lose one, that's a really great win rate. As long as my reward to risk ratios are in line as well, then I'm going to make a whole bunch of money. And then on the way down, when that trend shifts, I'll make 4, 5, 6 really great trades. I could have made 1, 2, 3, 4. If I was catching all these down legs, then 1, 2, 3, 4, maybe 4 or 5 really great trades on the downside before it flipped around and went against me. It's okay. So losing 1 for winning 4, that's still an 80% win rate. So we're not going to be too concerned. We're not chasing after perfection. We're not trying to win every single trade. We just, over time and over consistency, we win most of them and we make a whole bunch of money along the way. So don't worry about catching the exact top or knowing exactly when we're going to flip around. What usually happens is if we didn't get in right at the very beginning, you're like, well, okay, I didn't get 10 good trades out of this. I'm just starting to enter the market right now, and it might be a loser. Okay, fine. You start with a loser, that's fine. But then you make the 4 winners on the way down, then you get another loser, and then you make another 10 winners on the way up. You always start where you are, even if it starts with a loss. As long as you're consistent and you have a working system, it doesn't matter if your first trade was a loss. It might be traumatic if you allow it to be, and that will start to color all of your trading decisions going forward. So that's not what we want. We want to put that into perspective, so that even if you start out with a loss, it's not traumatic for you, and you don't allow that to continue to guide your trading decisions, that fear to keep on showing up every time you make a trading decision. So we just set the perspective correct. Even if this is your first trade and this happens to be where the markets turn around and you lose on that trade, that's perfectly fine, as long as you stick with it and you make the wins, and then you make the loss down here, and then you make the wins over here, then you make another loss on the way back down. It's okay. You're not going to win all of them. We don't expect to win all of them. But the value of following the trend and not anticipating or front running just because we believe that the market might change, then you'll be perfectly fine. Because if you did that, then back in November, we've been like, okay, that went up really far, and we are hitting this resistance, this horizontal resistance right here. We think that it's going to go back down. Okay, well, it didn't. We would have lost. And then over here, it went parabolic, and then now it's, it gapped up. Okay, so maybe we'll go short again because of that gap up. Then we would have lost. Then we consolidated and we went parabolic again, and we saw it go way high and but the +3 ATR and all that. And when we would have shorted again, and then we would have won for one day, but then we would have lost because of time value over in this direction. So we would have lost again. So every time we try to front run the market because it moved up too much or moved up too fast, we would have lost the entire time up. Whereas if we would just follow the trend, we would have won every single time, and you just might lose once at the very end. So we always want to follow that trend. We want to be aware of risks going up ahead, but we don't want to position because of our risks. We don't want to position because of fear. We want to position because of opportunity. And then we buy insurance and we protect ourselves because of fear or because of risk. So you always position based on the opportunity, not based on the risk. Anytime anyone or any company positions themselves because of risk, that's their downfall. When a company starts saying, well, I'm seeing a lot of market headwinds and I'm afraid that we're going to go into recession, and then all of this, that's when we need to protect what we have. That's when millionaires go broke, billionaires become millionaires, or companies go down to zero. That's because they shifted their perspective and they shifted from opportunity to fear. So you've got to keep your eye on the opportunity, and you hedge yourself because of the risk. If I'm the CEO of a billion-dollar company and I say, hey, there might be recession ahead, great, prepare for it. You're still focused on making money in your company. You're still thinking about growing your company, but you say, hey, there might be headwinds. Okay, so maybe we increase our cash holdings. Maybe we borrow a little bit less. Maybe we diversify our strategic partners. Maybe I get more supply chain sources. Those are the ways that we protect ourselves. It's not like, oh my God, business is going to be bad next year. We need to shut down. We need to start laying off tens of thousands of workers and all of that. Actually, you've seen Google do that. You've seen Meta do that. You've seen a whole bunch of companies this year in 2024, when the stock market is doing great and when the economy is doing great, laying off a whole bunch of workers. And you say, okay, that's a danger sign for a couple of reasons. Number one, we think that maybe the CEOs are doing that for a reason because they believe we're going to see a recession. Well, that's going to become a self-fulfilling prophecy if you keep laying off all your workers and you cannot continue to produce. So you're going to see that get impacted in the stock market. You're going to create the recession that you're afraid of if you keep behaving in that manner. So we want our companies to be forward aware of risks, but to be adopting strategies to take advantage of their current situation. And we want to be the exact same way in our investments. We want to keep on pointing our way upwards as long as this trend is upwards. And then we hedge ourselves. So when the first time that we're wrong, when the trend changes, we'll be wrong, but we'll be protected because of our hedges. And so we won't hurt that bad. And then we can flip our portfolio around and then take advantage of a movement downwards. So until it actually turns around, until we actually break this trend, we're not going to change the direction of our portfolio. If we look at QQQ, very similar, except we're testing, or we're very close to testing that trend right now. And then if we look at our Dow Jones, we're even closer to testing. This EMA 8 is very close to the EMA 20. We ended in between those two moving averages. Even though we tried to trade up, we traded all the way back down, and we ended up in between the two moving averages. If we keep chopping sideways, the MA 50 will join, and then the MA 90 eventually. We had high volume, so a little bit above average. The average was 3.67 million, and we got 4.25 million. So pretty significantly. So that is 0.6 versus 0.4. So 0.6 over, okay, about 10, 12% above the moving average, that's not nothing. So we had a good amount of volume where we try to trade up and we traded back down. That's not looking great for the Dow Jones, and the Dow Jones is the defensive sectors. And so unless a whole bunch of money is going to keep on pouring into tech, then this is going to drag on the markets. And does it look like a whole bunch of money is going to keep on going into tech? Hard, uh, hard to believe completely. It's not completely out of the question, but we've got the slowdown. So on Friday, we had a huge downward movement in SMH, so almost back to its EMA 8. So we went parabolic. We had a very sharp, large volume bar right here, at least double, more than double probably, almost triple. So the average was 8.7 million, and we got 22.5 million in volume and a huge downward motion bar. That's not very great news. The only thing that is okay about this is that we're still above the EMA 8. So do we bounce? Do we bounce off the EMA 20? Or does this continue to move downwards? That's going to be the major question. If we look at NVIDIA, that's the leader, looks basically exact same. A huge volume bar, more than double the average size, and huge movement downwards. That's the first time we've seen something like that. Yeah, so this is a reasonably large volume bar, but not nearly as much movement. Yeah, this is the first time we've seen that, except for maybe right here, that all the way back in August. That was followed by a period of consolidation before we went upwards again starting this year. So that was a 4-month sideways movement. So not looking great for the continued upward movement of NVIDIA. But I wouldn't say that it's going to come crashing down either. I'd be more convinced if I had a capitulation bar, which I don't. So we'll see. Maybe next week, a whole bunch of people start picking up NVIDIA. Hey, it's a bargain. And we start going upwards and we get a nice, huge green volume bar with basically the exact opposite situation. If I get the same bar, but it's green, and the same bar, but it's green, and it's at a high, then that would be capitulation to me. And I would anticipate that a correction is coming in NVIDIA, but not yet. So we'll have to see how the next week develops. So overall, our overall picture of the QQQ and the Dow Jones and the SPY is that we're continuing this uptrend, but we're seeing more and more danger signs. We've already seen a whole bunch of danger signs over the last couple of months, but now we're just they're just piling on top of each other. We want to be very, very careful now. When we look at IWM, we had this potential breakout of this pink area, but we broke out, came right back in, broke out, and we had this large red bar. It tried to go higher, but it came back down. So this is uncertainty. We're unsure right now. This could easily come back down. We don't have confirmation that this is going to continue upwards. So not excellent news, but also not terrible news. We do have 2 bars completely above that EMA 8 and above this this horizontal line right here. So that's it's still looking okay. It's still looking like it has potential. So we'll have to see next week. Does IWM pull back down into this range, or does it bounce and start going upwards? If it does that, then it would be interesting because money would be moving out of large cap but into small cap. I guess it's not really moving out of large cap. PY is still in that very, very comfortable range. So that would be positive, a net positive bullish. So we would expect this trend to go up for another leg in that case. Instead of saying, oh, we might pull down towards the bottom of this box and break the trend. If the IWM keeps moving upwards and money keeps focusing in on the large caps as well, then we would go up for another leg. Okay. Let's take a look at our CPC. 0.85. Okay. So starting to get a little bullish again, but not to an extreme. Then if we look at VIX, elevated VIX, well above 15. So if you had kept that VIX hedge that we put on about a week ago as an example, that would have done very, very well for you over the last week. So even though the S&P 500 is continuing to move upwards and challenge all-time highs, we did get a new all-time high on Friday, and we didn't close that much below Thursday, which was also an all-time high, but our VIX keeps going up. Yeah, VIX on Friday is above VIX on Thursday, the close to close. But if you look at the range of where the VIX traded within the day, we poked well above 15. We are at 15 and a half. So market makers are looking a little nervous this past week, which is interesting. Let's look at a weekly bar. Yeah. So this large green candle right here. Okay. So it's just another reason to be more cautious. We've got some pretty major economic data or inflation data coming out. So we just want to be very careful going into the next week. I would say the best strategies right now would be pairs trades. The safest, the kind of still great reward, but also have a built-in hedge. We'll focus in on pairs trades. So pairs trades can come in a few different forms. We could say strongest, weakest within a sector, strongest, weakest within an index, competitors, strong and weak direct competitors. Just because you're in the same sector doesn't mean that you're direct competitors. A classic example would be AMD, Intel. They're direct competitors. They are in the same sector. What might be less of a direct competitor in the same sector would be, for example, if I did AMD and CRM, or the ones, they're both tech, but one is semiconductor, one is software. Right? Or even within SMH, we could probably find pairs that aren't completely direct competitors. For example, okay, Universal Display versus NVIDIA. One is the chip, one is the display. Same with Micron. Micron does, well, actually, NVIDIA and MU would be good examples of direct competitors, but MU versus Broadcom, for example, are not direct competitors. So direct competitors are often really great pairs, except they'll have a high degree of correlation. So the likelihood of you separating in two different directions. Let me see if I can show this. Let me get a new layout. Here we go. Clean. AMD. If I add in Intel. Okay, so what you'll see is that they're direct competitors. So the times when one goes up and the other one goes down is kind of rare. So this one goes down, this one goes down, this one goes up, this one goes flat. This one goes up, this one goes up, this one goes down, this one goes down, this one goes up, this one goes flat. This one comes down, this one stays flat, This one comes down, comes down. It's very rare that one goes up and the other goes down. So in this period, it did happen. This one went up, this one went down, but not a huge amount because they're direct competitors. So for the most part, they'll move in the same direction. They'll just be moving at different rates, so different slopes. So this one moved very sharply upwards, and this one went very slowly upwards over the same period of time. And it's that difference in rate that allows us to make money. If we get this, then we make money super fast. One goes up, one goes down. If I'm shorting Intel and I'm going up AMD, then I'm winning on both sides. Over here, I'm winning on one and losing more slowly on the other one. I'm still making money, but I do have a natural hedge. So this type of pair, however, if we get actually, no. What I was about to say is not right. You're still very well hedged in, let's just say, like a COVID event where both of them come down sharply, while this one comes down just as equally sharply as the other one. And so you're still very naturally hedged. So direct competitors are very well hedged against each other, but as long as you pick correctly which competitor is stronger, then you'll make money because the rate of them moving in the same direction is different, and that's where you'll make the money. It's a little bit less perfectly hedged if you do the sector pair. So if I had chosen, I guess I should have kept that. If I had chosen Broadcom, so if I go AVGO, and then I add in, for example, well, let's just do the same, Intel. You can see that they're still pretty highly correlated. Up, up, sideways, sideways, continuing sideways, up, then down. So over this whole period, we could call both of them sideways. Then they both go up, then they both come down, then they both go up. Then we have some separation right here, finally. So it was very similar to AMD, actually, the same, very similar picture. But you can see that these two are actually on top of each other a lot more often than AMD versus Intel. Well, actually, they look pretty much the same. Okay, so let's see if we can find one in here that is less. Where's my bar chart? Did I close it? I guess I closed it. Okay, let's try OLED or QRV OLED. Okay, so here, these actually look a lot more similar to each other rather than we had separation in AMD and Intel. Here we have a lot less separation, especially in recent time. So these look a lot more like each other, and they're following each other almost perfectly. So they're in the same sector, so that's not too surprising. And you're not getting a lot of separation between these two, so this would be a very poor pair to try to match up. So in general, if I wanted to, if I wanted to use SMH, I would look at the strongest and the weakest to see, or one of the strongest and one of the weakest to see if I could get good separation. And if I can't, then I would choose a different sector. So if we go over here and we look at I have a cut right on the tip of my fingertip, so I'm having trouble typing. So I go NVIDIA versus ON or SWKS. Yeah, probably either of those. Okay, so this is beautiful. Look at that separation. I don't even like ON or Skyworks has just been flat, absolutely flat. So you can see this huge separation that has been coming over the past year. That huge separation right there. This would have been an amazing pair to trade over the last year. So this is what we're looking for, where they are in the same sector. One performs poorly, one performs really well. Or this, you wouldn't even necessarily say Skyworks performed poorly. It just went nowhere. It just went sideways. It actually went up 16%, and NVIDIA went up 453%. So there's this huge separation between those two. So this is what we're looking for in pairs. And sometimes they separate, like one, instead of just being flat, if Skyworks had gone down 20%, then we would have made money even faster. So pairs trades for sure. And then you would pick the direction of the sector very carefully. So let's take a look at our sectors, since this is the weekly market review. We want to see which sectors are performing well, where we might want to focus on in the next week. Okay, we've had this flip-flop between tech and defensive almost for a couple months now. So we can take a look at that. So last week, if I remember correctly, it was tech on top. No, we're on. Okay, let's go a week ago. Yeah, tech on top last week. And then basic materials. What happened? How did this happen? And then this week we've got, tech. Did we break our pattern? Let's go 2 weeks ago. Tech. I'm looking on the wrong time frame. Week. XLB. XLP. Okay. So that's February 23rd. Let's just do this over again. On the week, this week, utilities, basic materials. So we were defensive this past week. A week before that, technology, semiconductors. So we were growth in tech the previous week. And then a week before that, defensive again, XLP, XLB. So we just ended this week defensive. So if we continue the pattern, we would expect tech to lead this coming week. So we would look for pairs, call pairs or bullish pairs in tech and bearish pairs in materials or staples. And if we look at our indices, if I look at QQQ specifically, I would say, is QQQ, or would this be an okay place for QQQ to bounce? The answer is yes. We had a pullback or a sideways trading throughout the week and a pullback on Friday. It's an okay place for it to bounce. So if this trend continues, then yes, I would go bullish on QQQ. And then if this is the week that it breaks, then it's the week that it breaks. So if I have a sector pair on QQQ or on XLK or on SMH, then it's okay, because the one that I go bearish on will protect me from losses that I go bullish on. Okay, so we can take a look at a QQQ pair that'll be less correlated. There'll be less specific protection than if we went in on the more specific I get in the pair, then the more direct protection I get. But it's also more difficult to get that separation. So when we looked at Intel AMD, for example, recently there was a lot of separation, but in the months before that, there wasn't a lot of separation. So I would have made baby gains over a few months, and then the last month or so, I would have made more gains. So you just end up with those baby gains or baby losses just very even until you get separation. And you're more likely to get separation the less correlated they are. And the more specific you go, the more correlated they are. So if I go, the strongest in QQQ and the weakest in QQQ, that's going to be less correlated than if I say the strongest chip and the weakest chip. So there is less protection on the hedge, but more opportunity for me to make money in the meantime. Okay, so for now, for where we are, let's see over the last week, did we lose money on XLK? Where is XLK? It's right here. We did lose. It did go down. And the week before that, oh no, that's, okay, let's go 5. And then XLK made 1.83, and then if I go to 0, why does it do that? Okay, if I go to 0, XLK lost 1.49. Oh, it's not on the week. Yeah, I lost 1.49. Okay, so it's not like it's just chopping sideways or gaining less. It's actually losing money. So that makes it a little bit easier. So let's take a look at XLK specifically. Okay, so NVIDIA, AMD, Broadcom, FICO. That's interesting. So AMD, NVIDIA, Broadcom, FICO. I'm looking for a lower dollar price one and make it easier for us to get in. I guess I have the prices right here. I didn't have to. Micron, MU, $97. Let's take a look at Micron, MU. Would we go in on Micron right now? I would rather wait till it's closer to that EMA 8, but if we're paired up, it doesn't matter as much. WDC. Okay, WDC looks decent. It's just been chopping sideways, and we're near that EMA 8. So if we've been chopping sideways, even if we only chop in a range and we just go back up to right here, that's still an upward movement. And then when I see that upward movement, I can just close the pair. Or I can close Western Digital and put something else in place of it and keep the bottom pair. So Western Digital is looking okay. So we'll plan on WDC. And then at the bottom, we've got ON and Cisco. ON. Mostly sideways. CSCO. And sideways recently. Let's take a look at the charts over here so I can look at a whole bunch at the same time. Okay, so VeriSign. VeriSign Apple. Let's take a look at both of those. So option strat. If I do a long put in Apple out to April or May. Yeah, let's do May. $600. If I do VeriSign, also $600. Okay, I would want to know what the bid ask is, so how liquid these options are, which I can't do just on option strat. So I'd be indifferent, VeriSign and Apple. Okay, Apple sideways, it traded all the way up to the EMA 8 and got rejected back down. So it could just resume. It doesn't necessarily have to go and touch that EMA 8 again on its way down. And then VRSN. I'd probably go with VeriSign as long as it was liquid enough, because Apple is always in the news. There's always weird surprises with Apple. So it's a little bit safer for us to go with VeriSign. So I could say this is a sector pair. Save the trade. Paired with, was it WDC? Yeah. So I have $600 at the money, so roughly a 50 delta. So I'd want a similar. So my delta times the dollar invested would be 300. So I would want roughly 300 delta versus the amount invested on WDC as well. So we'll go to long call, WDC, 520. Okay, so close enough. So we could just go at the money call on WDC at the same time. Say that paired with VeriSign. And we'll see how that goes. Get our save trades. Those are the only ones we've got right now. Don't look at today's return. That's obviously not correct, but 0. So these should be 0. And then we'll see starting. So what we need enough time for them to separate. This is not going to be like a 1 or 2 day trade, most likely, unless WDC just flies upwards towards the highs over here. And it's most likely not going to be a 1 or 2 day trade. It's going to be at minimum a 1 or 2 week trade, if not a 1 month trade, to give it enough time to separate. Along the way, if we see good opportunities to take one or the other off, then we would just replace the one that we took off with another one to preserve the pair. Okay. All right. So I think that's a good picture of what we can expect over the next week and how to take advantage of it. We're just going to expect the S&P to continue to chop sideways or drift upwards. The QQQ, same thing, until we see a break of that trend. We're obviously a lot closer to it on the QQQ than on the SPY, so we'll watch the QQQ very carefully. The Dow Jones, same thing. We talked about how last Friday we talked about how this is basically curving like that. It's not really, it's hard to draw trend lines on this because it's curved. It's not following a linear path. but that EMA 8 and the EMA 20 are right next to each other, and it's going to start crossing it, both of those, very regularly, and eventually it might pick a direction. Hopefully it picks a direction. Otherwise, we're just chopping sideways until that MA50 comes and touches. And if it keeps on chopping sideways, then that MA90 will come and they'll all just go chop sideways. The other thing that we want to take a careful look at, or watch very carefully, I should say, is IWM. Does it stay above this peak line right here, or does it fall back below it over the next week? So that's the things that we really want to pay attention to. We do have heightened risk, even more so than last week, of us getting that pullback or correction in the markets. But for now, we're still up, we're still moving upwards, and we do have the potential of the S&P going up to this 30% level before we get a correction and pullback. So that's how our story and our view of the markets is developing. It's like, okay, well, we keep on going up, and until we see a break or we see capitulation, or this can just kind of pop upwards, a large green volume bar, maybe like this, and then a large green price bar associated with it. If I see that, then I would very carefully reevaluate also. But until one of those two events happens, either we come and touch or break this trend level right here, or we see a large green volume bar with a large green price bar, then we're just going to maintain the status quo, which is point our portfolio upwards, but make sure we're hedged, because we now have heightened risk. Before we were saying, okay, well, if we bounced, then maybe we won't hedge, because that hedge is not necessary until we pull back again. But now, with us being having all the heightened factors in it, then I basically want to be hedged at all times, which means the most profitable way to do that at the moment is to have specific paired hedges rather than trying to hedge my portfolio with one broad hedge. Because if that one broad hedge misses, then it loses a little bit of money, and it decreases the amounts of profits that I'm making. But if I'm paired up, it's possible for me to win on both sides, but still have that hedge protection. And so for now, since we're not at the edge, or it doesn't seem like we're imminent in terms of breaking below that downtrend, I don't want to hedge my entire portfolio. I just want to have specific pairs in place. Okay. Any questions? Anything you guys want me to go over? No? Okay. Well, in that case, I will see you guys tomorrow morning. Have a wonderful rest of your weekend, and we'll see what the next week brings us. All right, guys. Have a great day.
Thanks, Ken.